Planning to work while collecting Social Security in 2025? Stop right there. The government just changed the rules, and what you don't know could cost you thousands. By the end of this video, you'll understand exactly how to maximize your Social Security benefits while working in 2025, potentially saving thousands of dollars and avoiding costly mistakes. Welcome to Financial Area, where we break down complex financial topics to help secure your financial future. If you find this information valuable, be sure to like this video and subscribe to our channel for more essential financial insights. Let's dive straight into the critical changes you need to know about for 2025. The Social Security Administration has adjusted the earnings limits, and these changes affect millions of Americans who are collecting benefits while still bringing in a paycheck. For 2025, if you're under your full retirement age and collecting Social Security benefits, the earnings limit has been set at $23,400 per year. What does this mean? For every $2 you earn above this threshold, Social Security will deduct $1 from your benefits. Let's put this into perspective with a practical example. Imagine you're 63 years old, receiving $1,800 monthly in Social Security benefits, and earning $30,000 from your part-time job. Since you're exceeding the earnings limit by $6,600, $30,000, $23,400, Social Security will withhold $3,300 from your annual benefits. That's $1 for every $2 over the limit. This means approximately $275 would be deducted from your monthly payments. But here's where things get interesting for those reaching full retirement age during 2025. If you'll hit your full retirement age this year, you get a much more generous earnings limit of $62,160. And the penalty is less severe too. Only $1 deducted for every $3 you earn above that limit. This applies only to the months before your birthday month when you reach full retirement age. For example, if you turn 67, full retirement age, in July 2025, this higher limit applies to your earnings from January through June. If you earned $70,160 during those 6 months, you'd exceed the limit by $8,000, resulting in approximately $2,667 in benefit reductions, but only for those pre-birthday months. And here's something many people don't realize. Once you reach your full retirement age, these earnings limits disappear completely. That's right. After your full retirement age, you can earn as much as you want with absolutely no reduction in your Social Security benefits. This is a game changer for many retirees who want or need to continue working. Now, it's crucial to understand that not all income counts toward these earnings limits. The Social Security Administration has specific rules about what constitutes earnings for benefit calculation purposes. Income that does count toward your earnings limit includes wages from employment, self-employment net earnings, bonuses, commissions, vacation pay, and sick pay. Essentially, if it's reported on your W-2 or Schedule SE, it usually counts toward the limit. Let's talk about what doesn't count, because this might surprise you. Pensions, annuities, investment income, interest, capital gains, and other government benefits don't count toward your earnings limit. Neither do veterans' benefits, inheritance, or rental income from properties you own but don't materially participate in managing. This distinction is incredibly important when planning your retirement income strategy. For instance, if you're approaching retirement and have the option to restructure some of your compensation from salary to investment income, that could significantly impact your Social Security benefits calculation. Here's something many people overlook. Properly reporting your expected earnings to the Social Security Administration is crucial. If you know you'll exceed the earnings limit, reporting this in advance can help you avoid the unpleasant surprise of suddenly suspended benefits or demands for repayment of benefits you've already received. You can report changes in your earnings estimate by calling Social Security directly at 1-800-772-1213, visiting your local Social Security office, or in some cases, using your My Social Security account online. Be prepared with documentation of your expected earnings, such as pay stubs, contracts, or business records if you're self-employed. When should you report? Experts recommend reporting as soon as you know your earnings will differ from what you previously told Social Security. This is especially important if you get a new job, start a business, or receive a significant raise or bonus that puts you over the limit. If you fail to report and end up exceeding the earnings limit, Social Security might temporarily suspend your monthly payments until the amount over the limit is compensated. This can create serious cash flow problems if you're not prepared. Now, let's address a critical misconception. Many people believe that if Social Security withholds some of their benefits due to excess earnings, those benefits are permanently lost. This is absolutely not true. When you reach your full retirement age, Social Security automatically recalculates your benefit amount to give you credit for any months when your benefits were reduced or withheld due to excess earnings. This results in a higher monthly benefit going forward. Here's how it works. Social Security essentially treats those months where benefits were withheld as if you hadn't elected to receive benefits during that time. Since delaying benefits increases your eventual payout, this recalculation can result in a nice bump to your monthly check once you reach full retirement age. For example, if you claimed benefits at 62 but had benefits withheld for 12 months due to excess earnings, once you reach full retirement age, your benefit would be recalculated as if you had claimed at 63 instead of 62. This could increase your monthly benefit by approximately 5 to 6% for the rest of your life. This recalculation happens automatically. You don't need to apply for it or request it. However, it's always a good idea to verify that your earnings record is correct by checking your Social Security statement regularly. As we move deeper into retirement planning territory, we need to talk about Medicare. For many Americans, Medicare eligibility begins at age 65, regardless of their full retirement age for Social Security purposes. This creates some important planning considerations if you're working past 65. First, it's essential to understand that even if you delay taking Social Security benefits, you should still sign up for Medicare when you turn 65 to avoid late enrollment penalties, unless you have qualifying health coverage through your or your spouse's current employer. If you're working for a company with fewer than 20 employees, Medicare generally becomes your primary insurance at 65, with your employer plan becoming secondary. For larger employers, your workplace coverage usually remains primary. Additionally, your earnings from work can affect the premiums you pay for Medicare Part B and Part D. This is known as the Income-Related Monthly Adjustment Amount, or IRMA. For 2025, if your modified adjusted gross income from 2 years prior, 2023, exceeds certain thresholds, you'll pay higher premiums. This is where Chapter Medicare, a free service mentioned in our video summary, can be incredibly valuable. They help seniors navigate the complex Medicare system, comparing plans and options to potentially save thousands on healthcare costs. Their experts can help identify the most cost-effective coverage based on your unique health needs and financial situation. Now, let's discuss strategic financial planning when it comes to working while receiving Social Security benefits. There are several scenarios where it might make financial sense to claim benefits while continuing to work, even if it means some benefits will be temporarily withheld. For instance, if you need the additional income from Social Security to make ends meet, claiming early while working part-time might be your best option, even with the reduction. Or if you expect to live a shorter than average lifespan due to health issues or family history, claiming early could maximize your lifetime benefits. Conversely, there are situations where delaying benefits while continuing to work makes more financial sense. If you're healthy and expect to live well into your 80s or beyond, waiting until full retirement age or even age 70 to claim will result in substantially higher monthly payments for the rest of your life. Each year you delay claiming Social Security beyond your full retirement age increases your benefit by about 8%, up to age 70. This is a guaranteed return that's hard to beat in today's investment environment. Tax considerations also play a significant role in this decision. Up to 85% of your Social Security benefits may be taxable, depending on your combined income. Working while receiving benefits could push you into a higher tax bracket and increase the portion of your benefits subject to taxation. This is why consulting with financial and tax professionals is so valuable. They can help you model different scenarios based on your unique financial situation, health status, and retirement goals. Sometimes, the conventional wisdom about when to claim Social Security doesn't apply to your specific circumstances. Another strategic consideration is the impact on your lifetime earnings record. Social Security calculates your benefit based on your 35 highest earning years, adjusted for inflation. If you're earning more now than you did earlier in your career, even adjusting for inflation, continuing to work could replace lower earning years in your calculation, potentially increasing your benefit. Let's break down a comprehensive example to tie all these concepts together. Meet James, who is turning 63 in 2025. He's considering semi-retirement, reducing his hours to earn about $35,000 annually instead of his current $80,000. His full retirement age is 67, and if he claimed Social Security now, he'd receive $1,700 monthly. Since James would exceed the $23,400 earnings limit by $11,600, Social Security would withhold approximately $5,800 of his benefits, $1 for every $2 over. This means about $483 monthly would be withheld, leaving him with roughly $1,217 per month in benefits while working. However, when James reaches 67, Social Security would recalculate his benefit as if he'd claimed benefits later than 63, giving him credit for the months when benefits were withheld. Additionally, his continued earnings could improve his overall benefit calculation by replacing earlier, lower-earning years. In James's case, after consulting with a financial advisor, he decides to delay claiming until his full retirement age of 67. By then, he plans to fully retire, and his projected benefit would be about $2,400 monthly, significantly higher than the reduced benefit he'd receive at 63, even after recalculation. It's worth noting that the earnings test can be particularly complex in the first year you retire. Social Security offers a special rule that applies a monthly test rather than an annual one. This allows people who retire mid-year to receive full benefits for the months they're retired, regardless of their earnings before retirement that year, as long as they don't earn above a monthly limit in their retirement months. As we wrap up this comprehensive guide to working while receiving Social Security in 2025, let's review the key points you need to remember. If you're under full retirement age, be aware of the $23,400 annual earnings limit and how exceeding it will affect your benefits. If you're reaching full retirement age in 2025, you get the higher $62,160 limit until your birthday month, with a more favorable reduction formula. Only certain types of income count toward these limits, primarily wages and self-employment earnings, while investment income, pensions, and other unearned income don't count. Report any changes in your expected earnings to Social Security promptly to avoid complications. Remember that any benefits withheld due to excess earnings aren't permanently lost. They'll be factored into a recalculation when you reach full retirement age. Consider the Medicare implications of working past 65, including enrollment requirements and potential premium adjustments based on your income. Work with financial and tax professionals to develop a comprehensive strategy that maximizes your lifetime benefits and minimizes tax implications. The decision about when to claim Social Security while working is highly personal and depends on factors including your health, financial needs, expected longevity, and other retirement resources. Thank you for watching this detailed breakdown of the 2025 Social Security earnings rules. At Financial Area, we're committed to helping you navigate complex financial decisions with confidence. If you found this information valuable, please hit the like button and subscribe to our channel for more essential retirement planning guidance. Drop your questions in the comments below, and we'll do our best to address them in future videos. Until next time, here's to your financial success.